Hi, everyone. Welcome to the latest The Glass Half Full with Ryan and Sonu. As always, Sonu, one of the big themes we had at the start of this year was AI and the wave of AI. That's what we're going to talk about this week on the video as the AI wave continues. You've done a ton of work on this. How strong is this wave?
It's strong, and I can't say that it's cresting yet. I don't know if
Okay.
that's the right analogy, but cresting means that it's reached the top. But no, it's continuing. Look, you mentioned riding the wave and the wave continuing. That's what we titled our 2026 Outlook.
Yep.
When we wrote that, by the way, it was released in January, early January. We wrote it in November, right? For all of you to understand how the sausage is made. That
Yeah.
was, over 6 months ago. At that time, we estimated that these top big mega cap technology firms, the hyperscalers, there's not a recommendation in Microsoft's, Alphabet's, Amazon's, Meta's, Oracles of the world, will spend about $515 billion on capital expenditures on data centers, things like that, for AI-related CapEx
Right.
in 2026. That was up from $400 billion in 2025. So that's a big increase, right? It comes to about 1.6% of GDP. That's massive. Remember, this is not GDP of the Maldives, right? It's GDP of the United States of America, which is $30 trillion. Well, fast forward to last week, all these companies reported earnings, and guess what? They're going to spend even more than that, right?
Wow.
It takes the 2026 CapEx estimate to about $725 billion. We'd estimated about $515 billion. They're over $200 billion above that. That amounts to about 2.3% of GDP. By the way, 2027 is also higher. It's expected to be about 2.5% of GDP. These are amazingly large numbers.
So this joke might be for the older people out there, but Bob Uecker in the famous baseball movie Major League, just a bit outside.
Vaughn into the windup in his first offering. Just a bit outside. He tried the corner and missed.
So we said 515. We thought that was a big number. Now it's coming in over 700 billion. I mean, this spending, this AI wave, it continues to move. We've gotten into this stuff before, but the consumer's okay. The consumer's a little bit weak last quarter. There's some issues with the economy, but this tailwind, the AI and AI spending is really helping it. Now let's talk about earnings for a second. So we've done this last couple of weeks. We've got a strong earnings season. Like once again, talking about FactSet data, back at the start of earnings season, so the end of March, the Mag 7 earnings are expected to be up about 22% year over year. That's pretty good. Well, after all those earnings you just talked about, it's up to 63% year over year earnings growth in the first quarter from the Mag 7, the big 7 tech names. And, there are a lot of AI in there. I mean, that's just an amazing number. But earnings in general on the S&P 500 are up to 27% year over year. This time 3 weeks ago, it was 14%, not quite a double, but that is why we're hitting all-time highs. And it is we're talking AI in this particular, obviously, video series, but their earnings are strong across the globe. Earnings are strong across different sectors. Yes, technology is a big part of it, but look at what Caterpillar said. I mean, Caterpillar makes a lot of stuff. People use their stuff. Caterpillar said things are really good. Their stock went up 10%. Again, not a recommendation on that one, but just to show there's a lot of other factors to all this. What else do we want to talk about on the AI wave, Sonu?
I mean, there's so much, but one overarching principle, which one way to think about all this, there's so much spending. So, well, when companies spend, it's investment. When you and I spend, it's consumption. Right?
Okay. Yes.
But one company's investment is another company's revenue and profits. That's a connection between all this investment CapEx and what you see in the stock market, because what's the stock market driven by? As you just said, profits. But this stuff is making its way felt into GDP growth as well.
Yeah.
We just got GDP growth for the last quarter, Q1, 2% GDP growth. Not great shakes. It's not terrible either. It's running slightly below trend. But a big chunk of that came from AI-related investment, both on the hardware side and the software side. On the hardware side, Ryan, investment spending on IT equipment rose at an annualized pace of 43% in Q1. But when I say 2% GDP growth, that's after adjusting for inflation, right? And that's annualized in Q1.
Okay.
But IT equipment spending, 43%, right? Over the last 5 quarters, it's clocked in at 31% annualized pace.
Wow.
On the software side, investment spending rose at an annualized pace of 23% in Q1, which is huge, right? The pre-pandemic, let's say, forget the pre-pandemic, 2010 to 2024 pace, 15 years was about 9%. Last 5 quarters, software spending clocked in about 15%. So we're seeing this in CapEx spending. We're seeing this in the GDP numbers. We're seeing this in the stock market as well. It's for one of those times when a lot of the data I look at, a lot of the data you look at, it's all telling us the same story. It's the AI wave.
No question. And it wasn't that long ago. I mean, you and I probably did a video in this very video series about how tech was underperforming. There were worries about the AI rollouts, all this stuff. And now you wait a month and it's like, oh, everything was fixed apparently. Maybe it wasn't so broken. But technology in general, and well, first off, the S&P 500 in April was up over 10%. That's the second best April in the history of the stock market and the best single month since November 2020 for the S&P 500. But a huge reason for that big gain was tech, as we just said. Tech was up 20% in April. I believe it was the second best month in the history of at least technology index, which goes back a long time. Just incredible gains. And I think from let's talk about investments for a second here. Like, okay, big deal. Like, people listen to this. What's it mean to me? How am I going to make money on this? This is why you still wanted to own some technology, even though people didn't like technology 6 weeks ago. Tech has come back, and you and I had discussions on our team internally. If we think the S&P 500 can gain about 15% this year, which we do, we think mid-teens is very likely. And now it's like, oh, obviously we're up 6%. Well, we were down at the end of April. It was really far away. And you said many times, if that's going to happen, I'll bet tech has to come back. My, oh my, Sonu, has that taken place as tech took back the baton? What do you want to add to that discussion?
Now, I'll just add, just like I said, look, all this investment funding leads to profits. That's good for the stock market. But the other side, all of you watching this video are probably aware that inflation's pretty high now. Now, when we think inflation, we're thinking gas prices. Yes, that's directly related to what's happening in the Middle East. But it's not just that. The other side of all this investment spending, why are they investing so much of money? Because there's so much of demand for AI. And I think we've barely cracked the surface on this stuff, right? But that also means prices are going up because supply is not enough to keep up with demand. I'll just to put one number out there, the Personal Consumption Expenditures Index, which is the Federal Reserve's preferred metric of inflation, PCE index for computer software and accessories, that rose at an annualized pace of 59%, Ryan, in Q1.
Wow.
But again, look, one person's inflation is another company's margin expansion. That's another thing that you and I have talked about, driving the stock market. There are companies on the other side of this making money, right? If prices are going up, maybe it's chip makers, memory chip makers, obviously the energy companies too, materials companies. You look at the S&P 500 profit estimates, what's driving that up? Tech, as you said, but also energy and materials.
One thing great discussion. And one thing I want to point out, I hear this a lot, like, well, if you take out tech, earnings weren't that great. I said, yes, I call this like the Michael Jordan syndrome. Because yes, if you took Michael Jordan off the Bulls, they don't win 6 championships, but it still counts. Like every year we're going to have leaders and laggards for that matter. So listen, we can make excuses about it, or as investors, we can benefit from it. And this AI wave is real. Now, the last question, I guess, again, this is for the people that got my Bob Euchre joke. Okay. Well, someone's been around for a while. You did some work. I don't think you said it yet, but I'll point it out. You said like the AI or at least the spending on hardware and software is now more than it was as a percent of GDP than in the late 90s. Now, a lot of us have been around for a while. We kind of remember the late 90s. Yeah, it was a great time until it wasn't. Yeah. Walk me off the ledge, Sonu, why we're not just having another big bubble a la, the internet was amazing. I mean, listen, we're doing this because of the internet right now. But there was too much optimism, and then a lot of trouble happened. Obviously, 2000, 2001, 2002. I think the NASDAQ dropped 84%. Close enough for government work. Don't quote me there, but it's really close. Why are we not going to see that this time?
I mean, we could, is the short answer. But are we?
I don't want to hear that.
But are we there yet? I don't think so. It gets back to what I just said. I think demand for this stuff has barely scratched the surface. There's a lot more demand to come. And that's partly, so this is one big difference between what happened in the late 90s. During that tech boom, before we got the bubble in the bubble, we didn't see a lot of inflation. Right now, yes, it's not great that we have inflation, to be clear. But the fact that we have inflation tells you that demand is far outrunning supply. Yeah. Right? That's the other side. That's the other way I'm thinking about this, right? It's another signal that so far, at some point, maybe supply catches up, supply gets too much, there's oversupply. When does a bubble crash, if there is a bubble? when there's overcapacity.
Okay.
At this point, I don't think there's overcapacity.
Yeah, very interesting. I mean, lots of stuff there. We're watching this stuff every day. You've done amazing work, really breaking down, what we're seeing out there. And again, we called our outlook at the start of the year. We wrote it again in November, right around, I guess, Thanksgiving time. Ride the wave, and one of those waves was the AI wave, the CapEx spending wave. We thought that'd be continued a positive driver overall for the economy and the stock market. Unfortunately, the time we're doing this, I mean, I don't know what time people listen to it, but we've hit 13 all-time highs this year on the S&P 500, and we can thank technology a big part for why some of that's happening, and that's a good thing. So everybody, this was your latest glass half full. The AI wave continues. We'll see everybody next week. Take care. Thank you.